Imagine yourself as a carpenter. In order to make a masterpiece of woods, you need different tools to do that. We previously talked about different tools. Now, today, I want to talk about technical indicators. What are they really all about, and what are different types of them? Technical indicators are mathematical calculations based on volume and or the price of an asset. They are used to analyze past market data, find the patterns, and predict the future movements of the price. Technical indicators are widely used by traders in order to make informed trading decisions and help them out to become more specific and increase the chance of their success. In the upcoming sessions, I will talk about different types of indicators, the most known ones, the most useful ones, although there are like thousands of them out there, and we can combine all of them together, use one or a couple of them together, coming up with different trading strategies. But first we need to know the most popular ones, how do they work, then combine them with the previous knowledge that we have, then combine it with risk management, money management, and afterwards we can come up with different types of trading strategies for plan A, plan B, all the way to Z if you want, and I'm gonna help you out with that too. But here and now today, I want to introduce you the very first and most well-known trading indicator, moving averages. Do you remember the time which I told you previously in the previous sessions when we wanted to talk about support and resistance areas, or let's say static support and resistance levels? Well, moving averages are one of the most common ways to determine and identify the dynamic support and resistance levels. And how we can use them? Let's continue and find out. A moving average is a widely used indicator in technical analysis. It is used to smooth out price data and help traders identify trends. The moving average is a line that represents the average price of an asset over a certain period. As you can see, there are different types of moving averages: simple moving averages or SMAs, exponential moving averages or EMAs, weighted moving averages or WMA, and many more. Each of these moving averages has its own unique character, and traders use them based on their preferences and trading strategy. As I told you beforehand, there are many types of moving averages which you can use, but the most common ones are SMAs and EMAs. During hundreds, thousands of trades I myself made, talking to other traders and watching them throughout my career, I realized that everyone is using EMAs, and I will tell you later on within this video why. The SMA is calculated by taking the sum of the prices over a certain number of periods and then dividing them sum by the number of periods. For example, if we take a 20-day, or in case of day, let's say candles, 20 candles SMA, we would add up the closing prices of the last 20 days and divide it by 20. Let's go to the chart and understand what is it all about. Well, first things first, this is the TradingView platform. If you don't know how to work with it, how to sign up, how does it work, I made a complete dedicated video and a session for this, which I'm going to leave the link down in the description. Go check it out. I highly recommend it because this is our main tool to work with. Beside exchange platform itself, which we're going to take our trades there, this is only for technical analysis. Both even we can use it for fundamental analysis too, which I pointed out that previously. So go check that video first if you haven't checked that yet. This video is probably not for you. Let's first find the moving averages. How can we find them? It's simply can be done. This is the Bitcoin to USDT chart. So let me remove my watch list from here, and you simply move here to indicators segment and you just write down moving, and then it's gonna pop up here, this one, moving average. As you can see, there are like tons of indicators, you know, endless numbers of them, and the list goes on and on. These are the other people, programmers, who wrote different types of them, but we only want to use this one. This is the default setting of any technical simple chart. It doesn't matter if you want to do your technical analysis in MetaTrader application, on TradingView, or on your exchange chart, but these are the default indicators. So we're gonna choose this one. You can make it favorite, so it's gonna be in your favorite list. Click on it, so it's gonna be on your chart. How does it really work? If you take a look at up here, it says MA9 close 0 SMA 5. So what are these all about? Before getting to the settings, let me tell you something. What is an EMA doing? As you can see, it says close. So let me zoom in, go like this. So how a moving average actually works, it is really simple mathematics. In case of, for example, here, as you can see on top left here, the MA9, moving average 9, it means 9 previous candles. So if we count them like this is the today of the market, not current moment. If we take this, it is not closed. Candle must be closed to be calculated. So this is the reason that you can see the line of the MA, this blue line, ends here and it's not going further. It is a lagging indicator. It means that first the price must form, opens at a certain point, closes another certain point, and then the data must be collected by the indicator as a calculator, and then comes out as an exiting data, as you can see on the chart, as a line. So it means 1, 2, let's wait another 8 seconds, 7 seconds. This candle is going to be closed, and you see that the line is going to be moving forward for another candle. See? So here 1, 2, let me put an arrow counting them. 1, 2, 3, 4. You see here 1, 2, 3, 4, 5, 6, 7, 8, 9. So this candle here. It means what a moving average does, it says close. It means it is calculating the close price of these 9 candles and giving us one line as the average. So let me for a moment make the candlesticks disappear. So this line, as the name says, it's the average amount of the candle closes. So let me bring the candles back. This candle, I'm gonna put some marks on the chart, then we're gonna remove the candle. So it is this candle, as you can see, this candle here. It's a bearish candle, so it means the open was on the top, the close was on the bottom. If you don't know about the candlesticks, I have 4 dedicated sessions about them. I'm gonna leave the link both above here, down in the description. Check it out. But one here, and then another one was here, another close, then a bullish candle, so the close was here, and then another close here. I'm gonna just mark them: close, 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 and just like that. So if I remove the candles, you can see it means that this amount of travel, so like this, the price of the closes was here, then here, then here, 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 and then here. So this line, this MA line, moving average, is calculating the distance from this close to the next, to the next, to the next, and then calculating all of them, and then divide them to 9, and then this line comes up to your chart. Why the close of the prices? Why we are setting the close of the candles? Because a close of a candle means that the buyers or sellers, let's say the people, the players of the market, which I made another video about that previously, and you can check the link above here, they have decided on a certain point for the price of that particular asset. In this case is Bitcoin. It can be gold, it can be Apple stocks, it can be Ethereum, any asset within this market or any other market. They decided to for the price to be closed at a certain point. So what we decide must include the close of the price, because that was the price that people decided whether the market is going to be a bull market, or it's going to be a bear market, or it's going to be a range market. So this is the reason that we are choosing the close of the candles. If we go to the setting, as you can see here, we have different settings. First is the inputs. I highly recommend in the beginning of your trading career, especially during this course, coming up with me step by step, do not touch these settings, leave them to the default setting. As I tell you, if we need to change any setting, I'm gonna let you know. But here, it's a 9 period. It means previous 9 candles. If our time frame of the chart is set on 5 minutes chart, it means 9 times 5. So it is the amount of the time that it took for this moving average to form. Let me make it easier. If the line is here, ending up here, another 20 seconds, it's going to end up here. It means 9 previous candles. So if it is a daily chart, let me put it on auto. If it is a daily chart and you see 5 hours 45 seconds due to my time zone, it is left for this daily time. It means each candle takes 24 hours to be formed. It means this is a 9 MA. It means each MA took 9 candles or 9 days. So if we go to hourly time frame, it means each MA forms due to the average close prices of previous 9 hours, or let's say 9 candles. Do not mess up your mind with these 9 watts, 9 depends on your time frame, trading time frame. So I choose 5-minute time frame. It means 9 times 5. I choose the 5 minutes time frame in order to have more movements in the market. Later on within this video, I'm gonna show you more of these examples. Another thing which I'm gonna tell you is the SMA. You can simply just write down SMA and then you can see it here. Smooth moving averages is here. Make it favorite, put it on the chart. As you can see, what is the difference between this one and MA? Let me bring back the MA, both of them, and put them both length of 9. So let me bring that back. You can see there are a little bit of differences because it is more smooth. If I remove the candlesticks, so the purple one is the smooth moving average. You see, it doesn't have those sharp edges anymore and it is more smooth. Why should we use them? As I told you before, these are mostly used while we are using other indicators and they are written based on SMAs. Why? I'm gonna let you know later, don't worry. But SMAs, we do not use them, you know, on their own. I just wanted you to introduce you to them, and then I'm gonna talk about in the other trading indicators more about the SMA. The exponential moving average, or EMA, gives more weight to the recent price data. This means that the EMA reacts faster to price changes than the SMA. The formula for calculating EMA is more complex than SMA, but it is widely available in trading platforms. Now let's go to the chart and find some examples. The thing which I really like are EMAs, or exponential moving averages. This is the EMA or exponential moving averages. How do they work? Exponential moving averages are basically the same as moving averages, but they are faster and they are, let me bring the moving averages. You can see they are almost the same. The difference is not that much, but they are more sensitive to the price movements because, as I told you before, the moving averages, all of them, any type of them, they are lagging indicators. It means the price first must form and then they are going, it means the price, a candle must close and then it's going to give you the data. It means that we need something to be fast in order to not to lose a trade. If I have an indicator which, you know, I'm gonna wait for a signal, okay, I'm sitting here and waiting for the price to go up, and then suddenly it goes up like a sharp movement and I lose the trade, and it makes me really angry because I was waiting for a signal which was given to me too late. In the case of EMA, we are going to use them mostly for our trading. It is, I told you, as same as the MAs, but more sensitive to the price movement. But how do they really work? We need to know all about crossovers. In the classic trading era, we had a time that people used to trade only with EMAs. So let me bring another EMA to the chart. How to do that? You can just simply search for EMA and move another one. In the free version of TradingView Platform, you can add up to 3 indicators, not more than that. And we don't need really more of those. And later on, we can I can show you some hacks which you can do in order to have more indicators. But in the end of this course, I will let you know that the more simple the chart is, the more effective it's going to be in your trading career. I have seen lots lots of people, you can just go to the YouTube or Google them. They have a chart that everything is on the chart beside the price, which are the candles. This is a disaster. We don't want that. We want to avoid that. But first, we need to get familiar with our toolkit. Let me change the period of one of them to 20. Why 20? We have some fixed over time. People came up with some fixed strategies for the period of EMAs or MAs, which I'm going to write them down for you here. So 9 period, then 18 period, 20 period, T period, 100 period, 200 period. These are the most used ones in trading. But in order to tell you the old-fashioned type of trading was like this. People used to wait for a cross. Let me just remove the candles for a moment. Like here, occurring here. Let me change the colors for the shorter, or let's say smaller EMA to, you can go to the styles just like that. Change the color, the thickness. It is really simple. I talked about this previously in another session, but let's change the color to orange. And for the bigger EMA or the longer period EMA, I'm gonna change only the thickness so you can see them easily. So this cross here, if smaller EMA breaks the higher EMA, so in this case the 9 EMA breaks up from bottom to top, the 20 EMA, we call this, in this case, the golden cross. You really don't need to remember these names because in the end of the day, they do not affect your income, okay? But it doesn't matter what you call them. But I just need you to know, if you hear it somewhere, you don't panic or don't be surprised. So golden cross. People wait for a candle to close above the bigger EMA, the 20 EMA as the main EMA, and then let for a cross here. So let me bring back the chart here. So the cross happened, and then this candle closed above the bigger EMA. So they went for a long trade here, put the stop loss somewhere around here. It depends on the trading strategy, and then we're going to talk about this a lot later on. We have a lot to talk about, but if you just take a look at here, you can see we have lots of things. But before going for the rest of the trade, if you can see, here is a support area which we talked previously. If you haven't watched those videos, highly recommend it. Again, go watch them first, because they're mandatory to be watched. The price went down, had a reaction to this point, and then from here it shoots up. Let's look for other trading signals. So we have lots of candles telling us that the price tends to go up. See, this one is here, an engulfing candle. Of course, this candle here itself, it is a beautiful hammer. And then we have another signals, another engulfing here. We have another engulfing here. We have inverted hammer here, hammer here. So lots of signals. So this is another confirmation which we can combine to be more sure of a trading decision and make it informed. When the classic trading style says you can come out of this trade, we wait for another cross, or some people waited for the first candle to close below the main EMA. In this case, it is the 20 EMA. So there has been lots of ideas, but I'm not using them. You are not supposed to trade like this, but I want you only to know lots of people used to trade like this, somewhere around, coming out of the trade somewhere around here. So as you can see, it was a resistance level here. And it was a beautiful, beautiful shooting star happened here. Bearish spinning top, engulfing. Let me change the color here, not to confuse you. And it was a beautiful trade. Then we can see another good trade here. We had this cross here. Let me remove the price. This cross is exactly opposite of this cross. So it was a golden cross for a bullish market. For a bearish market, when the price tends to reverse, we call it a death cross. So let me just point out that like this. It's a death cross. It means that the price is about to die. It means it's about to go down. I don't know how they came up with these names, but it is not really important. Here, at this cross, at this candle, we could take another short trade here, put our stop loss here, and wait for the price again to cross over. So it was a crossover here. As you can see, it is a really nice example of the fact that it was not although it was with some profit, but you cannot make trading decisions like this. In this case, the amount of your risk which you took was a lot more than your profit. So if you want to trade like this, it doesn't really work. Only use these for entry points. Not only using these, we are only using these for confirmations. So in this case, we could just enter the trade, but how to go further with the trade, whether it's gonna go forward or not, we're gonna learn that in the future. But what you really need is that these can really give us good and strong signals in order to make some informed trading decisions. Moving averages can be used in various ways to help traders identify trends, support and resistance levels, and potential entry and exit points. For example, when the price of an asset is trading above its moving average, it is considered to be in an uptrend. On the other hand, when the price is trading below its moving average, it is considered to be in a downtrend. So due to the fact that we have always to be friend with the trend and do not go against it, in more simple words, again, if the price is above moving average and it's in an uptrend, or let's say in a bullish market, so we're only looking for some trigger points to enter a long trade. And while the price is going beneath it, underneath the EMA or MA or any type of moving average that we're going to use in the future in our trading strategy, when the price goes below it, so it means it's a bear market, it's in a downtrend. So we're only looking for some trigger points. What are the trigger points? We're going to combine our knowledge with the previous sessions, with candlesticks, with everything that we gathered around. We're going to have summary sessions to find them out. Don't worry. But we're going to look out for those trigger points, trigger moments, those golden points to enter a trade. Now, this time for a short trade in the case of the price underneath the moving average. Well, now it's time for that hack which I promised you to teach you. It is true that I told you that you cannot use more than 3 indicators on TradingView platform in the free version. But in some cases you can. In this case, in the case of moving averages, you can. I really like this one because, especially when I want to use a strategy in sometimes of the market, some types of trading, and I need more than 3 indicators and I don't want to buy the package and pay for it. So how to do that? You can just simply come here to the indicators section and type in 10 in 1. And the first one which pops up, this one written by someone whose name is Himanshu, and you can make it favorite, click on it. And then when you go to the setting, you can see you can have various numbers of MAs, whether it's RMA, SMA, EMA, WMA, HMA, VWMA. We only in this case need EMA. It is a good time to make some examples though. Let me put 3 EMAs. Let's put 5. All those numbers which I told you, all the lengths of the EMAs. So put one on 9, the other one on 20, the other one on 50, one on 100, another one on 200. And the colors, let me change them all to black, and the first one, let's make it gray. Any individual. But what I really want to do here, so if you click here, you can just change the transparency and everything. You can see they are all EMAs with different lengths. Do I need to use all of them? Of course not. I just wanted to show you how do they work. They are all EMAs in different lengths. 9 EMA, calculating 9 previous closes. 20, just like 9, and the story goes on. We really don't need to use all of them. There is a strategy which we can use, the crossovers which I told you beforehand. But in this case, I just only wanted to show you this hack which may become handy sometimes. But let me remove all of them and just stick to 200 EMA, just like that. Bring the candlesticks back, and you remember when I was talking about the dynamic support and resistance levels? Okay, here it is. In this case, it is just like the rules are the same as the static support and resistance. So we have a resistance level or some resistance level, but they are moving. It's not always like, it is not just always be here. So they are moving down in an angle like this, as you can see. And we had certain points which the price tend to go back from, and this is another trading strategy. I don't want to dive more into it because we have to know lots of other things, then come up with the strategies. But in this case, we see that the price went below the 200 EMA, so we consider 200 EMA as our main trend finder. So if the price is below it, it means it's a bear market, and we only look for triggers to go short. So here the price is below it. How many times it hit it? See, one rejection here, one rejection here, another rejection here. Then it could manage to break it through and go. And here now we could look up for long trades. So one long trade here, another long trade here. And you can see, you can find some chart patterns, candlestick patterns too. Here it broke this 200 EMA, this dynamic resistance level. So it's a resistance level. And then when the price breaks it, it becomes the support level, just like a static support and resistance. The rules are the same. So it's three white soldiers. Here, another opportunity. We have one bullish spinning top, and then it changed into beautiful engulfing. And in the meantime, it's three white soldiers. Here we have, you can see beautifully, we have three black crows. We have this beautiful bearish spinning top here. And you can find lots of examples. You can see this doji. Lots of confirmations are here for you to just take a trade. But long story short, let's just know the rules for now. If the price is below our main trend finder, which is 200 EMA in the most cases, we only go for short trades. We do not go long because, again, trend is our friend. We do not go against it. So if the trend is going down, we are going down with it and going short. If the trend tends to go up, so okay, we go up with it. But this is not only enough for trading, believe me, you cannot trade like that. And another rule of thumb is that the 200 EMA or let's say this dynamic support and resistance level, in this case when the price is below it, so it's a resistance level. When the price goes above it, it becomes a support level. So this dynamic resistance level is working like a magnet. When the price is going far from it, it's working like a magnet and trying to bring the price back to itself. And it worked here too. See, the price went up and it took it down to itself. And when the price goes really close to it, it becomes like a rejection point because it's a resistance area and it's trying to reject the price up to the moment that it's going to be broken or breached, which we're going to talk a lot later on. But I wanted you to know this is another trading strategy that lots of people are using or used to use in previous eras of trading, but it's not working nowadays because the market has changed. It's not just like before. See, for example, in this case, if you wanted to take trades, okay, going above it, go long, okay, hit your stop loss here. And you would have lost lots of money within this trading range here if you wanted to trade like that. If the price goes below the 200 EMA, so you go short, it doesn't hit your target. Then you want to go long, it doesn't hit your target again, and you have lost lots of money here if you only wanted to use this trading strategy. However, it is important to note that moving averages are lagging indicators. This means that they are based on historical price and may not be able to predict future price movements accurately. Therefore, traders should use moving averages in combination with other technical indicators and market analysis tools to make informed trading decisions. This is the reason I told you before, we cannot use only support and resistance levels. We cannot use only chart patterns or even candlestick patterns or even a specific indicator. We have to combine all the data and collect the data, and in the end, we come up with the decision whether we want to take a trade or not. Keep in mind that moving averages are only one tool in a trader's toolkit, or let's get back to the example of a carpenter, that this is only one of the tools that you have. It is important to understand the market, have a trading plan, and of course coming up with a really good risk management system, which I'm going to help you out in the upcoming sessions during this course, how to become a successful trader. Whatever session that I make for you, please just combine it with the previous sessions and add it up to previous sessions. And of course I'm going to have summary sessions just like previous session. If you haven't checked that, go check it out too. Just combine them together, practice, and always feel free to reach me out in the comments below and ask me whatever question pops into your mind. I would be really happy to answer you. If you really like the content that I'm making for you, please hit the like button and subscribe to my channel if you haven't done it yet, and share my videos with your other friends who are keen to know all about trading, about this messy world of trading, which I'm trying to make it as easy as possible, and I'm here to do that for you guys. Thank you for watching. See you in the next one.